In the early days of the internet, visionaries dreamed of a world where value could be exchanged as easily as information. This idea sparked the creation of digital currencies like DigiCash and e-gold in the 1990s. However, these early attempts struggled due to reliance on centralized control and susceptibility to fraud. The turning point came with the quest to solve the double spending problem, ensuring a digital asset could not be duplicated or spent more than once. Enter blockchain technology, a revolutionary system proposed to underpin a decentralized digital currency. Blockchain is a distributed ledger that records transactions across a network of computers in a way that ensures security, transparency, and immutability. This technology eliminates the need for a central authority, as every participant in the network has access to the entire ledger, fostering trust through collective verification. The blockchain operates on consensus mechanisms like proof of work, which require participants, miners, to solve complex mathematical problems to validate transactions and add new blocks. This process not only secures the network, but also introduces new coins into circulation. The ingenious combination of cryptography and consensus protocols ensures that the network remains secure and resistant to fraud. Cryptography plays a pivotal role by securing transactions and controlling the creation of new units. Public and private keys enable users to send and receive cryptocurrencies securely. The public key acts like an address, while the private key is a secret code that authorizes transactions, ensuring only the rightful owner can spend their funds. The emergence of blockchain technology set the stage for the first decentralized cryptocurrency, Bitcoin. This innovation promised a new era where financial transactions could be conducted without intermediaries, reducing costs and increasing accessibility worldwide. In 2008, amid a global financial crisis, an individual or group using the pseudonym Satoshi Nakamoto published the Bitcoin white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. This document outlined a vision for a new form of currency that would operate independently of central banks and governments, leveraging blockchain technology to enable secure and transparent transactions. Bitcoin's primary purpose was to provide a decentralized alternative to traditional fiat currencies, addressing issues like inflation and centralized control. By introducing a finite supply capped at 21 million coins, Bitcoin aimed to create a deflationary asset. Its open-source nature allowed anyone to participate in the network, fostering a community-driven approach to finance. The early growth of Bitcoin was modest, with a small group of enthusiasts mining and trading it. The first real-world transaction occurred on May 22, 2010, when Laszlo Hanyecz paid 10,000 BTC for 2 pizzas, a milestone now celebrated annually as Bitcoin Pizza Day. This event demonstrated Bitcoin's potential as a medium of exchange, sparking increased interest and participation. As Bitcoin gained traction, exchanges like Mt. Gox emerged, allowing users to trade Bitcoin for traditional currencies. This accessibility led to increased adoption and speculation, with Bitcoin's price experiencing significant volatility. Early investors saw substantial returns, while skeptics questioned its legitimacy and sustainability. Despite challenges, including hacks and regulatory scrutiny, Bitcoin's underlying technology and philosophy continued to attract supporters. By 2013, Bitcoin reached a price of $1,000, signaling its potential as both a currency and an investment asset. This milestone marked the beginning of mainstream awareness and set the stage for the broader cryptocurrency movement. Bitcoin's success inspired a wave of alternative cryptocurrencies known as altcoins. These new digital assets aim to improve upon Bitcoin's limitations or target specific use cases. Among them, Ethereum emerged as a groundbreaking platform. Created by Vitalik Buterin in 2015, Ethereum introduced smart contracts, self-executing contracts with the terms directly written into code. Ethereum's smart contracts enabled developers to build decentralized applications, dApps, on its blockchain. This innovation expanded the potential of blockchain technology beyond simple transactions, allowing for complex agreements and operations without intermediaries. Industries from finance to real estate began exploring applications on Ethereum's platform. Unlike Bitcoin, which primarily functions as digital gold or a store of value, Ethereum focuses on programmability and flexibility. Its native currency, Ether, ETH, powers the network by compensating miners and facilitating transactions. Ethereum's versatility attracted a vibrant community of developers and entrepreneurs, leading to rapid growth and innovation in the crypto space. The rise of altcoins also included projects like Ripple, XRP, aimed at facilitating cross-border payments, and Litecoin, LTC, offering faster transaction times. Each altcoin sought to address specific challenges or niches within the cryptocurrency ecosystem, contributing to a diverse and dynamic market. However, the proliferation of altcoins also led to concerns about market saturation and the viability of so many competing currencies. Investors had to navigate a complex landscape, distinguishing between promising projects and those lacking substance. This period underscored the importance of due diligence and the potential risks and rewards in the burgeoning crypto market. The year 2017 marked a watershed moment for cryptocurrencies as the market experienced explosive growth. Bitcoin's price soared from under $1,000 to nearly $20,000 within 12 months. This surge was fueled by a frenzy of investment and speculation, drawing mainstream media attention and a flood of new participants eager to capitalize on the rising market. Central to this boom was the rise of initial coin offerings, ICOs, a new fundraising mechanism where startups issued their own tokens in exchange for established cryptocurrencies like Bitcoin and Ether. ICOs provided an accessible way for companies to raise capital and for investors to gain early access to innovative projects. Over $6 billion was raised through ICOs in 2017 alone. However, the unregulated nature of ICOs led to numerous fraudulent schemes and failed projects. Scammers exploited the hype, leading to significant financial losses for unsuspecting investors. High-profile cases of fraud and the collapse of poorly managed projects tarnished the reputation of the ICO model. Regulators worldwide responded with increasing scrutiny. The U.S. Securities and Exchange Commission, SEC, began cracking down on unregistered securities offerings, while countries like China and South Korea imposed strict bans on ICOs and cryptocurrency exchanges. These actions aimed to protect investors, but also introduced uncertainty and volatility into the market. By early 2018, the cryptocurrency market experienced a significant correction, with prices plummeting and many ICO projects collapsing. While the bubble burst caused substantial losses, it also led to a maturation of the market. Legitimate projects continued to develop, and the focus shifted towards building sustainable blockchain solutions. After a period of consolidation, the crypto market began a remarkable resurgence in 2020. Amid the global COVID-19 pandemic, economic uncertainty led investors to seek alternative assets. Bitcoin was increasingly viewed as digital gold, a hedge against inflation and currency devaluation. This sentiment propelled its price to new heights, surpassing $60,000 in 2021. A significant driver of this bull market was institutional adoption. Major companies like Tesla, MicroStrategy, and Square invested billions into Bitcoin, signaling confidence in its long-term value. Payment platforms such as PayPal and Visa began facilitating cryptocurrency transactions, making it easier for consumers to buy, sell, and spend digital assets. Additionally, the introduction of regulated cryptocurrency investment vehicles like Bitcoin futures and exchange-traded funds, ETFs, provided traditional investors with safer ways to gain exposure. These products bridged the gap between conventional finance and the crypto world, attracting pension funds, hedge funds, and other institutional players. The bull market also sparked renewed interest in altcoins and decentralized finance projects. Ethereum reached new price records, driven by the growth of dApps and DeFi platforms. Investors diversified their portfolios, exploring opportunities beyond Bitcoin, which led to increased market capitalization for the entire crypto ecosystem. However, this rapid growth raised concerns about market overheating and potential regulatory backlash. Environmental issues related to Bitcoin's energy consumption came under scrutiny, and governments began discussing stricter oversight. Despite these challenges, the momentum suggested a fundamental shift in how cryptocurrencies were perceived globally. One of the most significant developments during this period was the explosion of non-fungible tokens, NFTs. NFTs are unique digital assets verified on a blockchain, representing ownership of items like art, music, and virtual real estate. High-profile sales, such as a digital artwork by Beeple auctioned for $69 million, brought NFTs into the mainstream consciousness. Decentralized finance, DeFi, also gained traction, offering financial services like lending, borrowing, and yield farming without traditional intermediaries. Platforms like Uniswap and Aave allowed users to participate in a global financial system accessible to anyone with an internet connection. DeFi's rapid growth demonstrated the potential to democratize finance. Moreover, blockchain technology found innovative applications in supply chain management, healthcare, and even voting systems. Companies leveraged blockchain for transparent tracking of goods, secure sharing of medical records, and tamper-proof electoral processes. These use cases highlighted blockchain's versatility beyond cryptocurrencies. As cryptocurrencies permeated global finance, governments and regulatory bodies grappled with how to manage this new asset class. Some nations, like El Salvador, embraced Bitcoin as legal tender, aiming to boost their economies and financial inclusion. Central banks worldwide explored central bank digital currencies, CBDCs, as a response to the crypto movement. CBDCs aim to combine the efficiency of digital transactions with the regulated framework of traditional fiat currencies. Projects like China's digital yuan and discussions within the European Central Bank signified a shift towards sovereign digital currencies. Debates raged over issues such as privacy, security, and the fundamental purpose of money. Advocates argued that cryptocurrencies empower individuals and promote financial freedom. Critics pointed to risks like market volatility, use in illicit activities, and the destabilization of monetary policies. These discussions highlighted the challenges of integrating decentralized technologies into established systems. Environmental concerns also took center stage. Bitcoin's energy-intensive proof-of-work consensus mechanism drew criticism for its carbon footprint. This led to increased interest in more sustainable alternatives like proof-of-stake, adopted by networks such as Cardano and Ethereum's planned upgrades. The path forward for cryptocurrency remains uncertain yet full of potential. Ongoing dialogues between stakeholders aim to balance innovation with regulation, sustainability with efficiency, and decentralization with security. The outcomes of these debates will shape the financial landscape for generations to come. Looking ahead, the potential for cryptocurrencies and blockchain technology to reshape the global financial system is immense. Innovations like Layer 2 solutions aim to improve scalability and transaction speeds, addressing current limitations. Concepts like the metaverse propose a fully immersive digital reality where cryptocurrencies play a central role in commerce and interaction. Education and accessibility will be crucial in this evolution. As more people gain understanding and access to cryptocurrencies, the potential for inclusive economic growth increases. Initiatives focused on bridging the digital divide can empower underbanked populations, fostering a more equitable financial landscape. Challenges persist, including navigating regulatory environments, ensuring security against cyber threats, and fostering sustainable practices. Collaboration between technologists, policymakers, and communities will be essential to overcome these hurdles. The future of cryptocurrency hinges on our collective ability to innovate responsibly. Ultimately, the rise of cryptocurrency represents more than just a financial shift. It's a movement towards redefining trust, ownership, and value in the digital age. Whether it's through decentralized finance, digital identities, or new forms of governance, the impact of blockchain technology is poised to extend far beyond our current imagination. As we stand on the cusp of this new era, one thing is clear: the intersection of technology and finance will continue to evolve rapidly. Staying informed, open-minded, and engaged will allow us all to participate in shaping a future where digital innovation and human values align for the betterment of society. As we reflect on the rise of cryptocurrency, we see a tapestry woven with innovation, challenges, and limitless potential. From the humble beginnings of Bitcoin to the expansive possibilities of blockchain technology, this journey is far from over. Together, we are not just witnessing the evolution of digital finance, we are active participants in shaping a new chapter of human history. If you like this documentary, remember to like it and subscribe to our channel.